The World Economic Forum reports that about 40% of large employers expect to reduce headcount where artificial intelligence can take over tasks, even as they plan to create new roles around data, software, and machine learning. In the United States, the labor force participation rate sits a little above 62%, below its pre-financial crisis peak, while productivity has begun to rise again after a long period of weakness. At the center of this quiet shift stands Alphabet, which now describes itself as an artificial intelligence first company and is investing tens of billions of dollars a year to build the infrastructure that will automate significant parts of the modern economy. Google's plan is not presented as a single masterstroke. It is a web of systems that sit underneath daily routines and corporate workflows. Search is already fully automated, with web crawlers and ranking algorithms deciding which pages matter in a split second. Workspace embeds generative models into documents, spreadsheets, email, and video meetings through Duet AI, which Google describes as a collaborator that drafts, summarizes, and analyzes on command. In the cloud, Gemini models are being marketed as an enterprise brain that links internal databases, customer records, and business processes. In advertising, new AI overviews and conversational search interfaces decide what information and which commercial offers are shown first. Each of these moves automates a layer of cognitive work that was previously carried out by clerks, assistants, analysts, or middle managers. This is the latest chapter in a familiar story. In the decades after the Second World War, the spread of electrification, factory automation, and early computing pushed United States labor productivity to grow at nearly 3% a year. That pace slowed after the 1970s, with only a brief surge during the dot-com era. Economists such as Robert Gordon argue that recent digital tools were less transformative than earlier general-purpose technologies, and that new devices were visible in lives, but not in the productivity statistics. Generative artificial intelligence is now being sold, including by Google, as a way to restart that stalled engine by converting more of the economy's working hours into higher output. McKinsey estimates that, combined with earlier waves of automation, generative models could add between roughly 0.5 percentage point and more than 3 percentage points to annual productivity growth, largely by taking over repetitive cognitive tasks. Inside firms, the mechanisms of automation are granular rather than dramatic. In Google Docs, Duet AI can generate a full project proposal from a short prompt, rewrite it in a different tone, and surface action items from a meeting transcript. In Sheets, it can classify raw data, propose formulas, and build scenario models that junior analysts once prepared manually. In Gmail, suggested replies and auto-generated summaries reduce the time spent reading and answering routine messages. On Google Cloud, enterprise customers are encouraged to build agents that connect Gemini models directly to order systems, customer support records, and financial ledgers, so that software can handle status updates, basic troubleshooting, and documentation with minimal human intervention. In search and ads, artificial intelligence systems increasingly determine which merchant, publisher, or employer is surfaced when someone expresses an intent to buy, learn, or apply. Across the economy, this kind of task-level automation compounds quickly. McKinsey estimates that by the end of this decade, activities that account for around 30% of working hours in the United States could be automated, an increase from just over 20% before generative models were deployed at scale. Brookings research suggests that more than 30% of American workers now hold jobs in which at least half of the tasks are technically exposed to generative artificial intelligence, with most workers seeing at least some portion of their tasks affected. The World Economic Forum's Future of Jobs report finds that employers expect technology trends led by artificial intelligence and information processing to be the most disruptive forces shaping hiring, task composition, and skills between now and 2030. For now, the aggregate labor market has not collapsed. The OECD's work on artificial intelligence in manufacturing and finance sectors finds little evidence of net job loss so far. Instead, firms report that artificial intelligence tends to reshape tasks and, in many cases, improve job quality by removing mundane work and reducing error, while also triggering anxiety about future displacement. Brookings' reviews of firm-level data reach similar conclusions. Adoption of artificial intelligence is associated with faster growth, more innovation, and, in the short term, higher employment inside adopting companies. Google executives echo this line. Google Cloud's chief executive, Thomas Kurian, argues that artificial intelligence will empower workers rather than replace them, and points to clients that rolled out contact center automation with no direct reduction in staff. Yet those assurances sit alongside concrete examples of job cuts, justified explicitly as efficiency gains from artificial intelligence. Cybersecurity company CrowdStrike recently announced that it would lay off about 5% of its workforce, citing operational efficiency from artificial intelligence at the same time as reporting strong revenue growth. A Senate report in Washington has warned that, under aggressive adoption scenarios, intelligent automation could threaten tens of millions of United States jobs over the coming decade across both white-collar and blue-collar roles. And the chief executive of Anthropic has suggested that as much as half of entry-level white-collar work could disappear within 5 years, as large language models take over many junior tasks in law, consulting, and finance. The divergence between firm-level gains and worker-level insecurity is already visible. The distribution of benefits and risks is uneven. A global barometer by PwC, which examined hundreds of millions of job postings, finds that wages in artificial intelligence exposed sectors are growing at roughly twice the rate of wages in less exposed sectors, and that wage gains are occurring both in jobs that can be automated and in jobs where artificial intelligence primarily augments human performance. A recent study by economists from Stanford University, the World Bank, and Clemson University observes that workers in occupations making heavy use of generative tools report higher earnings while there is still no sign of broad job loss. These patterns suggest that specialized knowledge workers in technology, finance, and advanced services, especially in large urban labor markets, are currently situated on the winning side of the automation frontier. By contrast, the risks are concentrated among entry-level and routine roles. Surveys summarized by the World Economic Forum show that a large share of employers now expect to reduce hiring for junior positions in fields where artificial intelligence can handle drafting, number crunching, or initial customer contact. This is consistent with private sector data showing a sharp fall in entry-level hiring in the technology sector since 2023. With firms preferring smaller teams of experienced staff using tools like Gemini and other large language models to absorb work once assigned to trainees. The result is a labor market in which mid-career professionals in metropolitan regions see their productivity and bargaining power reinforced, while school leavers and graduates outside major hubs face narrower on-ramps to stable careers. Geography and firm size add further fault lines. Google's automated tools are most deeply embedded in organizations with structured data sets, stable connectivity, and dedicated technology budgets. OECD surveys of small and medium enterprises suggest that while many smaller firms are experimenting with generative artificial intelligence, almost 1/5 report an increase in skill requirements and a need for more highly qualified staff, whereas fewer than 1 in 10 see skill demands fall. This raises the barrier to adoption in rural areas and in sectors where margins are thin and training capacity is limited. The risk is a double divide between workers who can work alongside automated systems and those whose tasks are automated but whose employers lack the resources to invest in new capabilities. The structure of participation in the labor market is beginning to adjust. Official data show that the United States labor force participation rate for adults has hovered around the low 60s in recent months, below pre-pandemic levels and well below its turn-of-the-century peak. At the same time, surveys from payroll and human resources platforms report that nearly half of American workers now use artificial intelligence tools at work without informing managers, often paying subscription costs out of pocket. Google's developer tools show a similar pattern. The company claims that generative coding assistants have lifted engineer productivity by around 10% in internal trials. The visible labor market remains stable in aggregate, but an invisible second shift has emerged, in which algorithms quietly handle an increasing share of information processing within each job. Education systems and training markets are struggling to keep pace with this change. The World Economic Forum estimates that roughly 170 million new jobs will be created globally this decade, concentrated in fields such as data analysis, cybersecurity, software development, and artificial intelligence. Yet these are roles that require solid foundations in mathematics, computer science, and statistics, along with softer capabilities such as communication and interdisciplinary reasoning. Google and other platforms have responded by funding industry certificates in data analytics and cloud administration. But these programs sit on top of school systems that still treat computing as a niche elective rather than a core subject. The result is a tension between a labor market that increasingly rewards concrete skills and an education pipeline that continues to allocate status through traditional degrees. Looking ahead to the next decade, most serious projections agree on three broad points. First, automation of tasks will continue to advance, particularly in clerical, administrative, and certain professional occupations. McKinsey's scenarios for the United States imply that nearly 1/3 of current working hours could be automated by around 2030, with the largest effects in sectors such as banking, retail, and healthcare administration. Second, large institutions do not foresee a simple employment collapse. Brookings analysts, drawing on current data, conclude that artificial intelligence has not yet produced a jobs apocalypse, while warning that disruption could accelerate if adoption and capability improve simultaneously. Third, wage dynamics are likely to become more unequal. PwC's global barometer suggests that artificial intelligence-intensive sectors already enjoy productivity growth roughly 4 times higher than less exposed sectors, with wages pulling away accordingly. Policy debates are beginning to catch up with this reality. Some proposals in Washington focus on cushioning adjustment through shorter work weeks, enhanced unemployment insurance, and stronger collective bargaining for workers affected by automation. Others emphasize investment, subsidies for reskilling, greater public support for community colleges, and tax incentives for firms that use artificial intelligence to augment jobs rather than eliminate them. Think tanks such as Brookings and institutes such as the Stanford Human-Centered Artificial Intelligence Program argue that the most effective measures will combine labor protections with active support for innovation so that productivity gains translate into broad-based income growth rather than narrow windfalls. Inside this emerging landscape, Google's strategy is clear. It aims to be the default automation layer for the global economy, embedded in documents, spreadsheets, corporate knowledge bases, industrial sensors, and consumer search habits. Its cloud division is building bespoke models for banks, pharmaceutical firms, and manufacturers, while its advertising and search products quietly allocate demand across millions of businesses. The company presents this as a path to higher productivity and new forms of work. And early evidence from multiple institutions suggests that in the short term, artificial intelligence can coexist with stable employment and rising wages in certain sectors. The longer-term outcome will depend on how quickly tasks at the core of middle-income jobs become fully automatable, and on whether public policy manages to turn efficiency gains into time, security, and opportunity rather than redundancy. The future of work in the United States under this plan is unlikely to be defined by a single dramatic break. It will be shaped instead by a steady saturation of artificial intelligence into every layered system that governs employment. The tools that workers use, the metrics that managers track, the courses that colleges offer, and the rules that legislators write. The data so far point to a path where automation expands and human work changes rather than disappears, but where the distribution of gains is contested. In that environment, resilience will not mean resisting the spread of systems built by Google and its peers. It will mean building the institutions, skills, and safeguards that allow societies to treat those systems as infrastructure for shared prosperity, rather than a quiet mechanism for narrowing it.